In 2008, trust in money collapsed. In 2009, a 21 million coin code was unleashed, not by governments, but by strangers, promising finance without gatekeepers. Now, while most ignore the shift, trillions flow into decentralized networks, and entire nations experiment with this new money. If code can rule capital, who controls your future, and what happens if it all goes wrong? When the world's biggest banks teetered in 2008, faith in money itself wavered. Bailouts and secret deals propped up the old order, but behind closed doors, confidence had cracked. In this vacuum, a name appeared: Satoshi Nakamoto. In January 2009, Satoshi published a white paper for a new kind of cash: Bitcoin. The code was simple, but the rules were absolute. Only 21 million coins would ever exist. No central bank could print more. Every 4 years, the reward for creating new coins would be cut in half, a ticking clock, hardwired to slow the flow. This was engineered scarcity, enforced by math, not trust. Satoshi's design was not just technical, it was a direct answer to the crisis. The very first block of Bitcoin's blockchain carried a hidden message: the Times 3 January 2009 headline reading, "Chancellor on brink of second bailout for banks." It was a warning and a blueprint. Instead of trusting bankers or politicians, the Bitcoin ledger would be open to anyone, verified by a network of miners racing to solve puzzles and add new blocks. Early adopters joined, drawn by the promise of money that could not be inflated or seized by decree. As more people mined, the supply cap and halving schedule became the backbone of belief. No matter how many joined, no more than 21 million coins would ever exist. In a world where governments could conjure trillions overnight, here was money with a hard stop: a digital gold rush mapped by code, not policy. The idea of programmed scarcity began to spread, setting the stage for a new contest over who should control value itself. Every transaction on a blockchain is recorded in a ledger that anyone can inspect, but no one can secretly rewrite. This security comes from how blocks are linked. Each new block contains a cryptographic hash of the one before it, forming a chain that exposes any attempt to tamper with past data. Changing a single number in an old block would break the entire sequence, instantly alerting the network. Instead of a central bookkeeper, thousands of nodes around the world each keep their own copy of the ledger. When someone wants to add a new transaction, the network must agree it is valid. That agreement is called consensus. In Bitcoin, consensus is reached through proof of work. Miners compete to solve a math puzzle, burning electricity to prove they have done the work. The winner proposes the next block and earns a reward. This system makes cheating expensive and public, but it comes at a cost. By 2021, Bitcoin's energy use rivaled that of small countries. Ethereum, the second largest blockchain, took a different path. In September 2022, it switched to proof of stake, a system where validators are chosen to create new blocks based on how much cryptocurrency they lock up as collateral. This change, known as the merge, cut Ethereum's energy consumption by around 99%. Validators have a direct financial stake in playing by the rules. If they try to cheat, they lose their deposit. Both systems rely on incentives, not trust. The code sets the rules, and the network enforces them. No single authority can rewrite history or approve transactions unilaterally. This technical bedrock is what makes blockchains resistant to censorship and fraud. It also opens the door to more than just money, because once a network can agree on what is true, it can run code that executes automatically. That is the foundation for smart contracts and decentralized finance. On Ethereum and other smart contract blockchains, Open source code has recreated the core machinery of modern finance, without bankers, paperwork, or middlemen. Stablecoins, pegged to the US dollar or the euro, flow across these networks like digital cash. They anchor the system, letting users avoid wild price swings and move money at internet speed. Most popular are fiat-backed stablecoins such as USDC and USDT, which hold real dollars in reserve. Others use algorithms and crypto collateral to keep their price steady, automatically adjusting supply in response to demand. Lending protocols like Avi turn code into a global money market. Anyone with crypto can deposit assets and start earning interest. Borrowers put up more collateral than they take out, a safeguard hardwired into the protocol. Interest rates shift in real time, responding to how much is borrowed or supplied, all without a human banker in sight. These pools hold billions of dollars at any moment, and the rules are enforced by code, not contracts. Automated market makers, or AMMs, like Uniswap, replace the old order book with a simple curve. Liquidity providers add pairs of tokens to a pool, and traders swap assets directly with the pool. The price moves along a mathematical formula as trades happen, always ensuring there is a price for every trade. This innovation unlocked round-the-clock trading for thousands of tokens, no matter the hour or location. By early 2025, the total value locked in DeFi protocols hovered around $50 billion, a metric called TVL, watched as closely as bank reserves. As Stani Kuleshov, founder of Aave, puts it, "What excites me is that anyone, anywhere, can access these tools. The barriers are gone. The foundations of decentralized finance are now set. Functional, programmable, and borderless, these protocols are not just experiments. They are running at scale, serving millions, and quietly redrawing the boundaries of what money can do." In El Salvador, money sent home from abroad is lifeblood. Remittances account for more than 1/5 of the country's entire economy. For years, families watched as wire services took their cut, sometimes up to 10% per transaction. In 2021, the government tried something radical. It made Bitcoin legal tender. The Chivo wallet launched with a $30 incentive, promising instant transfers and no middlemen. Lawmakers passed the measure with 62 out of 84 votes, and the president called it a leap toward financial inclusion. On the streets of San Salvador, some small businesses welcomed the change. A local shopkeeper remembers getting his first payment in Bitcoin from his cousin in the US. He cashed out the same day. It was fast, and he did not lose money to the bank. For others, the experience was less clear. Many merchants struggled with technical glitches, and confusion about the law's requirements lingered. Despite the rollout, most Salvadorans still preferred dollars. By 2025, under pressure from the International Monetary Fund and after a heated national debate, the government repealed Bitcoin's legal tender status. The experiment left behind both new digital habits and tough questions about who really benefits when money goes borderless. Central banks once raced to design digital currencies for everyone, but by late 2025, that sprint has lost momentum. Belize, Denmark, Iceland, Vietnam, and a dozen more countries have quietly paused or abandoned retail central bank digital currency projects. Instead of building digital cash for the public, many governments are turning inward, focusing on wholesale systems that settle payments between banks, not individuals. These institutional networks promise faster, cheaper cross-border transfers, but they keep control within the old financial order. In the United States, the response is even sharper. A recent executive directive blocks any move toward a retail central bank digital currency, calling it a threat to financial stability. Federal agencies face a hard deadline. Deliver a clear set of crypto rules before the end of February 2026. The message is unmistakable. Private innovation will lead on consumer digital money, while the state strengthens its grip on the pipes that move trillions behind the scenes. A senior regulator puts it plainly: we are not competing with stablecoins at the checkout counter. Our job is to keep the system running when the stakes are highest. As rules diverge across borders, the global map of money grows more fractured, with each country drawing its own line between control and competition. The promise of unstoppable money comes with sharp edges. In 2022, the FTX exchange collapsed overnight, erasing $8 billion in customer funds and sending shockwaves through the system. Headlines flashed as users scrambled to withdraw, only to find balances frozen. FTX was not alone. Mt. Gox lost 850,000 Bitcoin back in 2014, and Ronin Bridge saw $625 million vanish after a validator compromise. These failures exposed a new kind of fragility. When trust shifts from banks to code, a single bug or breach can drain billions in seconds. Smart contracts, once hailed as unbreakable, have been exploited through flash loans, oracle manipulation, and governance attacks. In April 2022, Beanstalk lost $182 million in a matter of minutes after a flash loan enabled an attacker to seize control of the protocol. Cream Finance, Wormhole, and others suffered similar fates, each breach leaving behind a forensic trail and a warning. Volatility adds another layer. Bitcoin and Ethereum have both seen price drops of 50 to 70% in a single cycle, wiping out fortunes overnight. Regulators are watching. In August 2022, the US Treasury sanctioned Tornado Cash, a crypto mixer accused of laundering over $7 billion. The move banned Americans from using the service and signaled a new era of enforcement where even open-source code can land on a blacklist. Security experts warn that as money moves faster and further, the risks multiply, not just for individuals, but for the entire financial system. Today, over $2 trillion move through crypto markets, while regulators scramble and entire economies watch from the sidelines. The power to redefine money no longer belongs to governments alone. As lines blur between code and currency, one truth remains: whoever controls the ledger shapes the future.